So, something huge is happening over at Tata Motors, one of India's absolute industrial giants. The company is in the middle of a massive strategic demerger. They're literally splitting the company in two. And look, this isn't just some boring corporate reshuffle. It's really the final move in a decade-long plan to unlock what many analysts believe could be billions in hidden value. What's the real story here? Well, it's this fundamental evolution, a shift from being a high-risk turnaround project to becoming a genuine quality compounder. And the proof? It's not just talk. It comes down to three massive milestones they hit by 2025. Getting their balance sheet to be net auto debt-free, grabbing a dominant 75% share of India's EV market, and seeing historic, record-breaking free cash flow from their JLR unit. All right, so why do all this? Why go through such a massive, complicated restructuring? Well, the answer is all about the strategic logic of unlocking value by separating two very, very different businesses. Let's break it down. Okay, now what's so interesting here is how clearly this lays out the before and after. Before, you just had Tata Motors Consolidated, this one giant entity that bundled everything together, from heavy-duty trucks to luxury electric SUVs, and that created what the market calls a conglomerate discount. But after this demerger in 2026, you get two highly specialized companies. First, the growth engine, which has all the exciting stuff, passenger vehicles, EVs, and JLR, designed to attract tech and growth investors. And second, the stability engine, which holds the steady commercial vehicles business, appealing to investors who are looking for dividends and yield. So the big takeaway is management is creating two pure-play companies that can finally attract the right kind of money for their very different needs. Okay, so with that context, let's dive into the bull case. And the optimism here isn't just a feeling. It's built on three really powerful data-backed pillars of transformation. First up, pillar one, the balance sheet. And wow, this chart right here tells a dramatic story. Think about it. Back in FY21, the company was drowning in over 80,000 crores of net auto debt. But through some serious financial discipline and amazing free cash flow from JLR, they managed to become net auto debt-free in late 2025. This isn't just about playing defense anymore. It completely flips the script, turning the balance sheet from a major liability into a strategic weapon, letting them invest aggressively in next-gen tech like hydrogen without being dragged down by old debt. Okay, pillar number two, their absolute dominance in the Indian EV space. I mean, this chart says it all. It's a testament to their incredible first-mover advantage. By early 2026, Tata commands a staggering 75% of the entire Indian EV market, thanks to smash hits like the Punch.ev. They haven't just entered the market, they are basically defining it. So you might be asking, how on earth do they defend that lead? Well, this slide shows their secret weapon, the Tata UniEVerse. This is so much more than just building cars. It's a whole ecosystem that uses the full might of the Tata Group. You've got Tata Power setting up over 10,000 public chargers, Tata Chemicals working on battery cells, and Tata Electronics handling semiconductors. So while other global players are struggling with supply chains, Tata has basically built a fortress around its EV business. And that brings us to the third pillar of this bull case, which is the absolutely incredible turnaround at Jaguar Land Rover. For years, JLR's profitability was a real question mark. Now, thanks to its reimagined strategy, look at this. EBIT margins are consistently above that 10% benchmark. That is a huge deal for a luxury car maker. And this profitability isn't happening in a vacuum. It's directly tied to the brilliant move of electrifying their most iconic models, especially the Range Rover. The pre-order numbers for that in the US and China have been off the charts. By mixing that heritage luxury with top-tier electric performance, JLR is now a cash flow engine. It's generating the strongest free cash flow in its history, and that money is funding the future of the entire group. Okay, that's a very compelling bull case. But we can't stop there. A thorough analysis means we have to be skeptical. So now we need to pivot and put on our critical hats to look at the potential headwinds and competitive threats that could throw a wrench in this whole positive story. So what could actually go wrong here? It's absolutely crucial to understand the key risks that could derail this amazing growth story. This slide really lays out the map of potential minefields. Globally, JLR's health is super sensitive to macro trends like interest rate changes in Europe and, of course, slowing growth in China. Back home in India, the competition is heating up. You have rivals like Mahindra with their born electric lineup, which could lead to a saturated SUV market. And perhaps the biggest risk of all, as the caption points out, is valuation. The stock is already trading at a premium, which means the market is already pricing in a lot of this success. That leaves very, very little room for any mistakes in their quarterly execution. All right, so we've looked at both sides. We've got this powerful bull case that's built on a real fundamental business transformation. And then we have the more cautious bear case that's focused on outside risks and sky-high expectations. So let's pull these two views together and figure out the key things to watch. So where does that leave us? What's the key deciding factor? Well, it's not just one thing. It really comes down to three critical variables that you need to watch like a hawk over the next year. First, does the demerger actually unlock the value that management is promising? Second, can they actually hit their ambitious FY27 EV volume growth targets? And third, can JLR keep those amazing 10% plus margins if the global economy starts to soften? The answers to those three questions will really tell us whether the bull or the bear case wins out. You know, when you step back and look at the whole picture, Tata Motors isn't just a car company anymore. It's really become an energy transition play disguised as an auto manufacturer. They have successfully moved beyond their legacy. The sum of the parts is finally, truly positioned to be greater than the whole. The company has redrawn its own map. The only question that remains now is one of execution.